So my name is Tariq Dennison. I run an investment advisory firm called G7 Asset Management. We are a Hong Kong and US-based wealth management firm, mostly running retirement and trust plan accounts for high net worth individuals and pre-high net worth individuals on both sides of the Pacific. Well, trade war makes great headlines. The fact is that nobody really knows which direction they're going to push currencies. The main thing which pushes currencies is buyers and sellers. The reason that the renminbi has weakened so far in this trade war is because tariffs have been imposed on imports of Chinese goods. China has responded by weakening their currency. That works just fine when the US economy is strong, but the thing to watch out for is that if the US starts entering recession and the Fed cuts rates, that will be the end of this cycle of a strong dollar. So those are the factors to watch out for in the near term. Well, it's huge because China is the 800-pound gorilla of Asia. It's no longer Japan. China is the biggest factory, is the biggest consumer, is the biggest energy user throughout Asia. So if China slows down, clearly it's already had an impact on Australia and on the Australian dollar. It would also have an impact on nearby countries which rely on a growing Chinese consumer and moving up the value chain. So far, if you look at other countries, Vietnam and Bangladesh have actually benefited from China moving up the value chain and providing more opportunity to them. So while you might see some vultures hoping for picks at a slowing China, overall we all want to see China growing and being healthy. Well, really what it is it's a reset and a rebalance for an imbalance that had been developing for too long under China's membership in the WTO. Really, ever since China joined, there's been an enormous trade imbalance, and it's been entirely one way. Americans have saved too little and bought too many Chinese goods. Chinese have saved too much and bought too many American assets. So even though a lot of the emphasis is on the trade of goods, I think it's just as important to look at the imbalance in capital flows and China investing in the US. I've actually said, given relative valuations now, we should see more American investors buying more Chinese assets to restore some of that balance. Well, I'm very bullish on the ETF sector overall because for many smaller accounts, it provides the easiest way to accumulate world-class, institutional-class ETF positions. Now, the nice thing is several of our members of the event here today know there are great ETFs in almost any fixed income category you can think of. You want dollar high yield, euro high yield, China bonds, there's probably an ETF for that. Now, there are other categories we'd like to see more of. Leveraged distress, I'm sure we'd like to see more ETFs in that category, and individual Asian high-yielding currencies, we'd like to see more of that. So that's an area where we think they're going to be developing more. Well, I'm a fixed income geek, so I'm probably the wrong person to ask about this. But this is an excellent conference in that it brings together many of players from different sides of fixed income and FX markets in Asia. So that includes fund management companies, wealth managers, bond traders, technology and information service providers. In a world where there are tens of trillions of dollars of negative yielding bonds, we're all looking for ways where we can at least provide our clients some positive yield across our FX portfolios.